I've always admired people that figured it out when it comes to investing, that didn't have to lose sleep, didn't have to become people that are glued to their screens, become a Robin Hood soldier, or lose sleep because they're stressed about their investing. And part of it is putting some of your money on autopilot, invested in something that is managed for you without you having to worry about it too much. And one of the best ways to do this is to invest in high dividend ETFs. I see people get confused all the time with terminology. An ETF simply is an exchange-traded fund. It's a fund, think about a vehicle that is loaded up with companies from a variety of different sectors. So that it gives you an exposure to a bunch of different industries. And today I want to walk you through 3 ETFs that, in addition to being well diversified across these industries, they're loaded up with companies that pay really high dividends. The first ETF I want to talk about is the Vanguard High Dividend Yield ETF. If you look at this description page here on Bloomberg, you see top left corner, the ticker is VYM. If you're looking for it in your trading account or you want to allocate money to it, VYM is the ticker. But when you look at the description here, it shows you that it tracks the performance of the FTSE High Dividend Yield Index. Now, this index is an index of worldwide companies that pay higher than average dividends. So this really tries to mirror the performance of companies that really give you a substantial amount of dividend yield. At the bottom right, you see the inception date is in 2006. So this is an ETF that's been here for 14 or 15 years. And the expense ratio is 0.06%. So this is important. You always want to know how much you pay somebody to manage money for you in terms of allocating money to ETFs, right? This is somebody that makes sure that the allocations are done right and that it's well diversified, etc. So they charge a little bit of a fee, but you always want to make sure that you don't pay too much in these fees. So 0.06% essentially is for every $10,000 you invest in this ETF, you will pay $6 a year. So $6 a year, this is really nothing when it comes to how expensive or cheap ETFs can get, but this is very, very cheap. Now, if you look at the performance of this ETF since inception, looking at this chart here, you see that it's basically done very well. It has the typical corrections that we have seen in the stock markets because it's loaded up with companies, obviously, that trade up and down. 2008, big correction, 2020, COVID-19. But overall, this ETF has done really well. And then switching to the performance here over the last month, 3 months, year to date, 1 year, 3 year, 5 year, you see that this is all in green. This is doing pretty well here. But the important thing I want to show you on this page is under 10. So the bottom right, you see the 12-month yield, which is at 3.07%. So this is important. This is important when you're comparing investing in dividend yielding companies or dividend yielding ETFs. 3% is pretty good given that interest rates right now are at 0. So this gives you a 3% plus in terms of yield by investing in this ETF. And then just to see more details of what's actually in this ETF, you go to holdings and you see Johnson & Johnson as the highest pick, and then JP Morgan, and then a bunch of really blue chip large US companies that pay substantial dividends. And if you kind of want to spread it by sector, you look at the allocations here, you see that banks and pharma companies together are about 25% of this ETF, and then you have electric, semiconductors, telecommunications, retail, and a bunch of other sectors. So this is an ETF that really pays good dividend, that is well diversified, that has been here for 14, 15 years, and that has a lot of assets that are managed, and it's kind of a stalwart of what should be in your portfolio if you want to have money allocated to assets that pay you dividends. The second ETF I want to talk about is the Schwab US Dividend Equity ETF. Again, on this description page here from Bloomberg, you see a lot of data, but I'll point out the important stuff. Top left corner, you see the ticker. That's SCHD. So again, SCHD, if you're looking for it in your trading account or your retirement account. This ETF has about $17 billion in market cap. That's how much money is invested in this ETF. And again, bottom right corner, you see the inception date in 2011. So this ETF has been here for 9 years and shows decent performance, and the expense ratio is the same as the previous ETF from Vanguard at 0.06%. So again, very, very cheap ETF. For each $10,000 you invest in, you pay $6 in yearly fees, so that's practically nothing. Looking at the chart for this ETF over the last 9 years since inception, it's pretty much a straight line up, except for 2020 when we had obviously that sell-off in March, April. And since then we recovered pretty nicely. Now switching to the performance sheet on the description page again, you see similar performance to the ETF we just looked at from Vanguard. It's all in green, but the important stuff here again is the 12-month yield. So bottom right here under number 10, the 12-month yield that is this ETF pays you is 3.08%. So again, that's pretty high considering rates are at zero. These companies keep growing, the stock prices keep going higher, and they also pay you this dividend. Now switching to holdings, you see Exxon is number one. Now Exxon hasn't done all that well as a stock in the stock performance in 2020, although it's beginning to recover. But Exxon pays really high dividend. They pay over 7% in dividends, so that's really high. That helps this ETF. And then you have Texas Instruments, Qualcomm, PepsiCo, BlackRock, and other large US companies there. And if you look at the allocations across sectors, here on this sheet, you have banks and financial services are just over 20%, semiconductors, beverages, oil and gas, insurance, computers. It's a well-diversified ETF, again, that pays really nice high dividend, that gives you that diversification plus the dividend yield that should be part of your portfolio. And finally, the third ETF on the list is the iShares Select Dividend ETF. Ticker DVY. Again, if you're looking for it in your trading account. But again, on this description page from Bloomberg, you see that this is an ETF that invests predominantly in mid and large cap US stocks. The market cap is $15 billion, so really large ETF again. And looking at the inception date, bottom right here, you see that this ETF has been here since 2003. So this is the oldest of the three that I'm showing you today. And the expense ratio is 0.39%. So again, for each $10,000 you would invest in this ETF, $39 would be your fees that you would pay, to somebody to allocate, diversify for you. This is really not a lot of money for an ETF that is performing well and paying you a high yield in dividends. If you look at this chart here showing you the performance since inception, so obviously you have the run up from 2003 until 2007, at which point we started going through the last financial crisis 12 years ago, but then a nice recovery all the way to 2020 until we got to COVID-19, March, April, and then since then we recovered again. If you switch to the performance tab on this description page, you see at the top left here in green again, these numbers are actually better, especially in the last 3 months, than the previous two ETFs. And if you look at the dividend yield, bottom right here, the 12-month yield is 3.49%. So that's better than the previous two, in fact, which slightly compensates for the higher expense ratio. Looking at the holdings, you see that Prudential, Viacom, Wells Fargo, which is doing a lot better now under the new CEO, Charlie Scharf, is turning the company around. They had a lot of scandals, conflict with the Fed, etc. And then a bunch of oil companies. So again, this is well diversified. If you look at the tab for the allocations, you see that you have electric and banks are more than 30% of this ETF, and then you have insurance, oil and gas, and a bunch of other sectors again. So look, all these three ETFs are showing you a nice diversification into, across companies, across industries, into companies that pay you high dividends. And like I said in the beginning, if you don't want to be glued to your screens, if you don't want to become the Robin Hood soldier that loses sleep because of their investments and options they're buying or selling, etc., you want to have some of your money allocated to ETFs because the work is done for you, right? And in particular, in these cases, you're buying ETFs that are paying you high dividends or higher dividends than other companies or ETFs. So these are chosen for that effect. I can tell you that I used to manage and advise for a large investment bank on some of the biggest fortunes in America. I used to manage portfolios for these families, and I can tell you that these ETFs were sitting in their portfolios. And so why shouldn't they sit in yours, right? This is a no-brainer. Autopilot kind of investment into companies that pay you high dividends that will do well over time, and you don't have to worry about it every day. So that's it for today. Hopefully you enjoyed this conversation. Give a like to the video, subscribe to the channel. It's going to help the visibility for this channel. I post a lot of content on investing, managing money, helping people become smart about money and build wealth. So hopefully you can help out as well and get more exposure for this channel. And thanks for listening. I'll see you next week.